We've been in a 30, 40-year cycle of rates coming down, and we're probably turning the corner. I think what most people really want that are trying to protect wealth is to hedge against, what do I do if central banks can't print money anymore, or there's a currency crisis? Like, what kind of assets historically have gotten people through a crisis from beginning to end where they've ended up with most of their purchasing power intact?
Hello and welcome to Wealthion. I'm Maggie Lake, and I'm joined by Brett Rentmeester, founder and managing director at Windrock Wealth Management. Hi, Brett. It's great to see you.
Nice to see you as well. Thank you for having me.
So today we are going to focus on alternative investments and the role they can play in better diversifying our portfolios. But let's start with this concept of diversification itself. I think it's a term that's thrown around a lot, but what does it really mean to have a well-diversified portfolio? How do you define that?
Yeah, it's a great question. I mean, diversification, a lot of people view that as kind of a boring topic until you get into really trying times and you wish you had more of it. I'd say before, how we define it is a little different than maybe how the market defines it. I'd say the market has historically in the US defined it as this mix of stocks and bonds and kind of this traditional, whatever you want to call it, 60% stocks, 40% bonds. And I think part of that is because we've been spoiled in the US. We've been in an environment since the early 80s where interest rates came from double-digit rates down to zero, literally zero during COVID. And at the same time in the early 80s, the PE ratio on stocks was single digits, and it's come all the way up. So we've kind of been spoiled by this idea that this mix of stocks and bonds in recent history, this round of investors has been very good, and it hasn't really pushed people to go outside of that boundary. But we can get into it more, but we're a little more students of history, and we recognize that there are plenty of environments where stocks can get hurt and be down for many, many years. Same with bonds, and sometimes together, both stocks and bonds losing money. And that's clearly the kind of environment that would trouble investors.
Yeah, we certainly are not used to that. And you're right, we tend to think of them as offsetting each other. So what are you seeing now that makes you think about those periods in history? What's happening what's the parallel, or what's happening that makes you think we're entering another period where we could see them both go down together, or some sort of, sideways paltry returns?
Yeah, I think, well, part of it is, I mean, our story is not to abandon stocks and bonds. It's simply to think outside of just the simple stock and bond paradigm. And I think, what's making us think about this are a couple things. One is what I just mentioned. We've been on this amazing trajectory since the early 80s of falling interest rates. And interest rates have the impact of, falling interest rates tend to boost all asset values, including stocks, including bonds, including real estate. But we went down to 0% rates during COVID. Can't go any lower. In Europe, things went negative, which almost defies logic. And so, yes, we've bounced a little, but what we've learned about bond markets, and what we believe, is they go through generational cycles. So if interest rates tend to drive things, bond markets tend to go through 30 to 40-year type cycles, meaning, we've been in a 30, 40-year cycle of rates coming down, and we're probably turning the corner. The last time we saw a rising rate environment in this country was the 1950s all the way to 1980. And that was a 3-decade period where bonds lost money as far as relative to inflation or purchasing power. And we've had similar episodes in the stock market that normally coincide with rising interest rates and things like that. So we've had 2 periods in the US in modern history where stocks are down and it's taken you 16 years to get back to even on an inflation adjusted basis. So, take your age today, add 16 years, and tell me if you're really committed to investing for the long run. And that was, of course, the famous 1929 through the Depression, but also 1966 to 1982. So we see it in the US, and we've seen even more dire outcomes like that outside the US.
Yeah. I like that period of the 60s that you're referencing, because we all know the Depression was terrible and we hope we can avert something like that. But it doesn't have to be in that extreme situation where you can have this really long period of underperformance that people aren't just used to. I heard you mention twice inflation. And I think this is important because if you think about getting out of that zero interest rate environment, then you'll think, well, savers got screwed during that period. And okay, higher interest rates means you can put money in the bank and get a, get some money back on that. It's good for savers. There's this idea, but the inflation part matters a lot, right? Can you touch on that a little bit?
Yeah, it does, because of course it feels a lot better today getting 4% on a short-term US Treasury than it did getting close to zero. But if we're getting 4%, but inflation is really running, maybe CPI's at something lower, but our real basket of goods is going up 8% a year, we're not getting ahead. We're falling further and further behind. And so, yeah, I think for most investors, the game is really not just to go up every year, it's to increase your purchasing power. And I think a lot of people are feeling the pain of inflation. Of course, inflation, as we talk about it, is a year-to-year growth rate, but the prior inflation didn't go away. So a couple of years ago, when we had that big spike of inflation, that's still represented in most costs. That's why, even though people feel like their investment balances are up, you look around and homes seem really expensive, vacations seem really expensive. Go down the list. Most people haven't really kept up.
I think that's so incredibly important what you just said, because we're kind of trained to look at returns. That's when we open our portfolio or our statement, we see year to date return, and that's what we tend to grab onto, and we feel pretty good if it's up there. But the idea of growing your purchasing power as the goal that you should be looking for, I think is just such a great clarification for everyone. So there are going to be some people who listen to this and say, okay, well, I understand diversification is important. I'm diversified. I own defensive names in stock market. I've moved from growth and tech to something more safer and more defensive, or I've gone up the quality in bonds, only investment grade, and that's diversification. Is that how you see it, or why is it necessary to think kind of outside the world of stocks and bonds?
Yeah, I mean, there's certainly an element to that. I mean, diversification can be done at many levels, and there is something about within an asset class. Are you taking a lot of risk? Are you more defensive? But I think what we've seen is if you're in a really bad market environment, like let's just take April recently when the market was down, it mattered what kind of stocks you had, but on average, you were probably down with it if you were in US stocks. Or in a period where interest rates are rising rapidly, you can have a variety of bonds, but on average, most bonds are going to get hurt in that environment. And again, I think we're a little spoiled in the US. We've had not only this period of falling interest rates, but we've also had massive intervention by central banks. And this is really a global story. And it feels good in the near term, but what they've done is essentially when there's market weakness, they pump money in the system, and that kind of reprops everything up, right? We had that during COVID, we had that during '08, but it also creates high valuations in both stocks and bonds, and more of a risk, we believe, that if any tenets of that break, you're more in an environment where stocks and bonds can go down together. And, you can certainly look even to recent history, the European financial crisis. You had countries like Greece within the last decade that lost in a very short period 90% of the value in the equity markets and 70% or more in the bond markets. So there are times, crisis periods, where stocks and bonds can go down together. And irrespective of like which stocks you have, you're probably going down with that if your main exposure is there.
So what is a better path for diversification these days? If we're in this new era, we're moving out of that 30 to 40-year cycle, and we've got this intervention that's created froth and overvaluation. What
Yeah.
should investors be looking at? What should diversification look like?
Yeah. Well, again, this is not a recipe to abandon stocks and bonds altogether. It's
Right.
really just to broaden a perspective beyond that. I think the first, there's kind of two segments of alternative investments. I would say the first is, how do I really prepare myself if we have a crisis? What are the reasons we could have a crisis? Well, war is a crisis, like World War II. Another crisis can be caused simply by central bank intervention. We've printed all this money. It's driven everything up to an unsustainable level, and now it's got to come down. And then the third related to that is about every 100 years, there's a change in the currency system in a major way. And so you can look back in history, and it was, it's been the dollar, but it's a little long in the tooth. It's over 100 years. Prior to that, it was England. Prior to that, Spain and Portugal. So we're kind of also nearing this point where currency markets might have some changes ahead, and people talk about that. So I think one element is what is a piece that can get me through a crisis? And when you really boil it down to simple logic and look at history across different countries, you can say, well, what are basic necessities for people? One is shelter. I'd call that the right kind of rental real estate. One is food. I'd call that the right kind of productive farmland. And third is some kind of sound money or something you can save in and believe the value is going to hold. And historically, that's been gold and silver. And I think more recently, people are open to the idea that Bitcoin might be playing a role in that. So it's kind of this triangle of necessity goods that can weather a lot of storms. And all those things share one characteristic. They're all some sort of hard asset that just can't be printed out of thin air. I mean, even Bitcoin, maybe you can't call it a hard asset, but it has a limited number of Bitcoin that will ever exist. So I think that's important.
Yeah, certainly has an appeal for people who consider it borderless and sort of, more global as we're looking at increased geopolitical threats. So it's interesting. I want to back up for a second because when I hear alternative investments, I by nature think that they're fringy maybe and riskier.
Sure.
But it doesn't sound like you're talking about them as the ultimate safe havens.
Yeah, well, I've described the first bucket of how we view alternatives. The first bucket is if I want to diversify, but I'm diversifying to protect wealth against the really bad events that history can dial up, that's probably not going to be just stocks and bonds. I mean, stocks and bonds are going to yin and yang and weather a storm. And maybe if stocks are down 20%, maybe you're down only 10 with bonds. But I think what most people really want that are trying to protect wealth is to hedge against, what do I do if central banks can't print money anymore, or there's a currency crisis? Like, what kind of assets historically have gotten people through a crisis from beginning to end where they've ended up with most of their purchasing power intact? So that, yeah, you're right. It's not talking about the risky stuff, and it's really hunkering down. What kind of things should I consider? Now, there is another side to it, which is the opportunity of alternatives.
Oh, so that's really important. So alternatives as safety, and then, but there is another part if you're thinking about diversification of a way to try to look for opportunity or grow, reach for that yield, right? So what's in that bucket?
Yeah, so for us in that bucket of things we actively invest in are a couple things. One would be private lending. So we talked about how interest rates have come up, and you can get 4% in a short-term treasury today. But if you're willing to take a little bit of illiquidity, there are plenty of opportunities to lend money to businesses against assets where maybe you're getting double or more from that, but you've got to have the right people that know the space, and you've got to understand what you're getting into. But private lending would be an idea of that. So maybe I don't want to be sitting in normal bonds, but maybe I do get comfortable with lending money into, unique niches. So that would be one category. I think a second category would be something along the lines of venture capital. It could be private equity, but let's call it venture capital. Startup companies. Can I get access to a group of startup companies that might be disruptive years from now? I mean, I can tell you right now, through some of the accelerators we're involved with, these groups that, mentor and fund young entrepreneurs, that so much of it now is AI, and not just broad-based AI, like people that have domain expertise in one vertical area, and they want entrepreneurs that can use AI to disrupt whatever that area is. So that would be a second one, a higher risk category. And you've got to tie up your capital for a longer period of time, but it allows you to be part of the entrepreneurial community that's made America so great. And then you also have, of course, things like other cryptocurrencies beyond Bitcoin. Including AI. There's decentralized artificial intelligence projects that are being, tokenized. And there's so many things going on in that world that we think are interesting, that many investors are either scared away from, or they have advisors that just aren't willing, to look out in those kind of areas. And then finally, there are things that kind of are in between, like energy type assets, which can range from pipelines and energy infrastructure all the way to, should I own, nuclear energy and natural gas plays? So pretty wide range, honestly.
Yeah. It's fascinating stuff. You mentioned illiquidity, and I just want to circle back to that because it sounds like one of the appeals, and I think one of the reasons that so many people are heavily reliant on equity exposure is because, of course, ETFs and all the innovation that unleashed, you can jump in and out. It's very liquid. You can make a decision and change your mind and get out of something. And there's a certain comfort with people that what do we need to understand about duration diversification when we're talking about some of these alternatives?
Yeah, well, it's a great point, and I think you have to be very careful about your liquidity needs. Um, what we tend to see is, for younger people, sometimes there's an opportunity to take some illiquidity risk in an IRA. You can actually do a fair amount of private investing in an IRA. And for young people, the mindset is, well, I'm not going to take this money out until my 70s anyway. So they have a long horizon. They can kind of set it and forget it. It feels more comfortable. As people retire, there's generally a feeling like I'm retiring, I'm 65, and I need to hang on to all my money. But the reality is, they still might have 30 or 40 years to invest for. So I think it's all about managing really what your lifestyle is and what your needs are relative to these opportunities. I will say some of the what I call illiquid investments we do might have 6 months of illiquidity, and some go up to 12 years. So there's a very wide range out there that, at least we help people manage.
Yeah. And it sounds like, correct me if I'm wrong, but it sounds like we've got to kind of adjust our thinking to diversity around duration because, the idea that you can get, invest in something like an Nvidia and get 100% return on that, not return, but see 100% gain and still be in this super liquid, that type of growth isn't something that's always available in a vanilla stock market. That we've kind of been through an extraordinary time. I
We
don't think we
have.
should benchmark our expectations based on that.
Yeah, I totally agree with that. And that's one of the risks, of course, when we talk about US equities, as good as they've been, as excited as people are about AI, and we are too, we have to be very careful about valuations. And when you really look at some of the measures, everybody's got their preferred measure of long-term historic valuation. I think when you're really looking back decades, you look at things like the Shiller PE ratio, and what you conclude is, other than the tech bubble, we're at one of the highest levels ever in those kind of historical measures. We, exceeding where we were in 1929. And clearly, when this gets really elevated and we're at high levels, historically, the future returns the next 10 years are not as great. So I think it's also, you've got to think about where you are in a cycle. And it's hard to shift gears, but once you've had great run-ups, you've got to shift into a gear that says, hey, maybe we need to take some risk off the table and play it safe here. And when markets are down, you've got to do the opposite. You've got to fight your kind of normal emotional hesitation to buy when things are, there's blood in the streets.
It's hard, right? I know we say that all the time, but it's so hard.
It is.
When we're talking about allocation, I'm sure there are going to be people sitting here listening to this thinking, okay, this makes sense, but how do I know how much should I have in these? How diversified should I be? It's hard. Everyone's needs are individual. So I know that
Yeah.
it's impossible to answer that question. But generally, are any general rules of thumb when we're talking about allocation? And
Yeah.
should you have all of these different types of alternatives, or do you need to look at your needs and just having some is okay?
Yeah, I mean, it really is so client specific because, you could have someone that has a portfolio but is going to need all the money for living
Mhm.
expenses or retirement. You can have others that have money that might last a number of generations. And so there can be different mindsets. I think, in general, the idea of the crisis bucket of like owning gold and silver and some Bitcoin, some hedges to a currency, we believe that should be everybody.
Mm.
Other things like farmland and venture capital, and that's really, you've got to have the time horizon and maybe belief in the thesis to want to do some of those things. Private lending is kind of in the middle. I think there's opportunities where you're not locked in for that long necessarily. So I think it is very dependent, but I would say in general, most of these allocations, if you do anything less than a couple of percent, it probably isn't meaningful. But
Mhm.
anything that pushes 10% is a large position. So, a lot of these are going to be in the, 2.5 to 10% type range for people.
That's a great rule. That's a great sort of, I think at least beginning point for people to
Yeah,
think
it's a
about this
starting
because
point.
you need a starting point, right? Otherwise it's sort of, it's very daunting to think about making those changes when you just have no idea if you haven't been allocated in these areas. I just want to finish up. I'm so interested and intrigued to hear you talking about tokenization and blockchain.
Yeah.
Uh, how what kind of risk profile does somebody have to be in that? And I ask that with a bias because I think many thought and maybe still think that it's a super risky area.
Sure.
But there's a huge amount of financial innovation going on. If you sort of take the word crypto out of it and you just think about financial innovation, I mentioned ETFs before, right? There was a time
Yeah,
when we didn't have them and we think nothing
that's
of it
right.
now. And so, how do you think about that in terms of a risk profile before, introducing that idea to a client?
Yeah, well, it's changed. I mean, we were one of the first advisors in the country that were aware of recommending cryptocurrencies, and we did our early writing on some of these topics back in 2012, 2013. So we've been in the space a long time. And in the earlier days, it was higher risk clients that were willing to do something that seemed like a technology that was unproven but had potentially big upside. I mean, it
Mm,
still is a technology, but when you look at it and you compare it in an adoption curve like any other technology, whether cell phones or the internet, we're tracking above where the internet is in adoption globally. And
mm,
so it puts us in internet terms around 1997. So think back to 1997. That's when we never would have believed anybody would make a purchase on the internet or be able to watch a video or stream anything. And so today it's a different philosophy. I'd say our belief is even for conservative clients, they should have some exposure to at least the core cryptocurrencies like Bitcoin, but in small magnitude,
mm.
right? Whereas a riskier client that wants to take more risk, they have a larger allocation, but they're also probably broadening out into other tokens. And it actually, what I was saying about the illiquid investments, private investments largely being illiquid, there's also an exciting future. I don't know if it'll happen. I think it will, where slowly some of these illiquid assets get tokenized so that in the old days, I might have been in a private real estate investment and I was tied up for 7 years. Now it becomes tokenized 2 years from now and I can trade my shares to somebody else. So some of this illiquidity might go away.
Amazing stuff. This has been a fascinating conversation. Just a final thought to leave folks with, because it sounds like from what I'm hearing you say, we are really, this isn't a moment in time. We're in a kind of regime shift, and we all have to rethink the way that we're approaching our portfolios.
I think that's right.
Great stuff. Brett, thank you so much. Appreciate
Thank
your
you.
time.
Thank you.